Top three things in my notebook this morning. Number one, oil. Number two, consumer discretionary stocks. And number three, the 10-year bond yield. So the first thing on oil, obviously oil is collapsing. You have a lot of people out there who are a little bamboozled by the move, but the reality is that you've seen translation and really breakdowns across the equity complex that is linked to oil. So again, while oil is signaling immediate term trade oversold, again, short-term duration, it is still a raging bearish formation. So again, it's bearish because it's in what we call the fourth quadrant. And in the fourth quadrant, you have neither growth nor inflation. In fact, both are slowing. So again, you don't want to be long oil. You don't want to be long energy stocks from a trend perspective. We'd reiterate that this morning with energy actually down on the year now, XLE down 4.3% for the year to date. Now, point number two is an interesting one because I think I've had this question only 5,000 times. But if the oil price is going down, Keith, why don't I buy the consumer stocks? Now, again, they're talking about the tax cut there. Now, the tax cut from the all-time high in American cost of living, which doesn't include getting your rent cut or anything of that nature, while it will at some point matter, it certainly has only provided you deflation in consumer discretionary stocks. Now, as you know, XLY, which is consumer discretionary, has been one of the worst places to be in the U.S. stock market for the year, but it's also been one of the worst places you could have been for the last 5 weeks while oil prices are falling. So again, very simple point. We don't like the consumer until we like the consumer. Again, you can't just superimpose these series into your portfolio immediately or you're going to feel the wrong side of that. Now, finally, the 10-year bond yield has figured this out throughout the year. The 10-year bond yield is crashing for the year to date, down 23%. Again, in rate of change terms, don't forget that the 10-year yield started the year at 3.03% and is currently at 2.31%. So again, at this point, we would just say that Mr. Macro Market agrees fully and completely with Hedgeye Risk Management on the growth slowing call, even though nobody else does. Those are your top three things.